Amazing. Welcome, everybody. I will give you just a few minutes to start settling in, but good to see you all this Tuesday evening for the VetU Tax 101 Being Tax Savvy event. Well done for being here live. Those dedicated to knowing a little bit more about this very important topic, one of those that I think keeps a lot of us up at night. I know I was just having a chat with Nicola and she was saying how good it is to work with so many vets and vet nurses who are very switched on and also very compliant and like to make sure they've checked everything out properly. Obviously, we do that diligently in our own jobs as well. So that feeds back into a lot of the other things that we're doing too. So thank you for being here. I can see we've got the waiting room is just filling up. So I'll let a few more of you in. And please do drop into the chat box if you've got specific questions. Those that you did drop in when you registered, they are ready for us to ask Nicola right at the end as well. But if you do have anything that comes up as you go along, it would be lovely to know where you're all dialing in from as well. So drop that into the chat, let us know, and we'll give it one more minute and then we will get started as well. So amazing. Thank you for being back with us again, Nicola. It was a really we had brilliant feedback from the last session that we did back earlier this year. And I know quite a few people really benefited from your expertise between then and now as well.
Thank you, Katie. It's really good to be back. I really enjoyed the last session and good to cover it again.
And I know we're going to be going over a few of the changes that are on the horizon and various timescales over the next few months and years as well, which I think forewarned is forearmed in a lot of these circumstances, isn't it?
Yeah, absolutely. Yeah, we are, well, I like to think of myself as quite a proactive accountant. So we're always looking to the future, looking to advise what's coming up. Like you said, forewarned is forearmed, and you can do something about it when you know something's coming up rather than being reactive and fixing a problem after it's happened.
Definitely. I think we're all about that, certainly as vet professionals as well. So I can see we've got a few people that are telling us where they're dialing in from. So Berwick upon Tweed, we've got Super Sussex. I'm in Manchester. Nicola, you're in Barnsley, aren't you?
Barnsley, yeah.
We've got the Cotswolds. We've got all sorts of lovely places coming up as well. So still letting a couple of people in, but I think we can get started. So again, thank you all so much for being here. We are going to be covering Tax 101, being tax savvy, which of course is a topic that we needed to get someone far more expert and specialist in this area across for rather than the VetU team. But that's what we're all about, supporting you and helping you take care of your finances and get your independence, which is where our happiness lies. So we just wanted to touch on a little bit to start with about the VetU team and what VetU is all about for those of you that don't know. And then I'm going to introduce Nicola as well. So the VetU team is made up of 4 vets. There's myself, there's Ebony Escalona, there's Matt Dobbs, and there's Paul Horwood as well. And we all come from different areas of the profession. We've all got different ranges of experience, from being employed, self-employed, locum, being employers, working in farm practice, small animal practice, equine. And also we've all had different journeys with regard to how much support that we've had, whether that was when Paul and Matt were being spoken to by financial advisors, when they were graduating, to when Ebony and I graduated and we really felt like we weren't given any financial support or education. So we really do like to help empower you as vets and as vet nurses to know about the information that perhaps we haven't been taught, meaning that you can look after your health, you can look after your income, and you can look after your future as well. So this session this evening, we're going to be demystifying a topic that could really be seen as quite tricky and, excuse the pun, but quite taxing, for us to look a little bit more about what that involves, where we might have pitfalls, where we should be declaring money, what we should be doing about whether we're self-employed, do we have limited companies, do we have side hustles, is there anything that we can claim as expenses? These are all questions that we get asked a lot and maybe we're not given much formal education about either. So Nicola and I were speaking just before we came on air as well, and we were saying how important it is to acknowledge that each one of those topics that I just listed could very probably be its own webinar in itself. We could make this into like a 10-part series to cover it all really in depth. So Nicola's going to give us an overall view, sort of a skyline, so that you've got an awareness and an idea of all these different areas, what's involved. And if you need to dive more in depth into personal things for you, because we're all different, and that's one of the things that we really do promote, is that our financial independence and taking control of our own finances is important. There will be chance to speak and book a call in with Nicola at the end if you are interested in using their accountancy services and run through your own personal circumstances as well. So we'll go over that shortly. But without further ado, I will introduce Nicola. So Nicola is a chartered accountant and a chartered tax advisor. She does work at Harris & Co., who are both chartered tax accountants and chartered tax advisors as well. She's one of the partners there. She has worked with a number of vets, including myself, and she's also got a portfolio of GP practices. So she's more of with the medical side of things, and she understands a lot about our profession as vets and as vet nurses as well. She's really passionate about empowering women in business and has started many local initiatives near to her and near home as well. I've said already, I use her as my accountant. I think she's brilliant, biased or unbiased, but I know we're going to have a really good session with Nicola this evening, diving into some of those questions that maybe we've all wanted to ask, finding out more about Tax 101, as well as seeing what is new, what's on the horizon, and answering your questions. So any questions that you do have, this is a really safe space as VetU. There are no stupid questions. If you do want to ask anything anonymously, you can direct message myself, you can direct message Matt and Ebony, who are both on this call as well, and we can ask those questions to Nicola for you. And again, like we say, if you're thinking it, somebody else is probably thinking it as well. So I'm going to hand over to Nicola to run through her slides now. And at the end, we'll fire in those questions that you submitted when you registered for this event and any more that we've got time to answer as well. So thank you, Nicola, over to you.
Thank you, Katie. Thank you for that kind introduction. It's really nice. So we'll start with the question, what is tax? That was one of Katie's straplines, I think, on the marketing for this webinar. So I thought we'd just start with the basic principles of what is tax. So according to Wikipedia, a tax is a compulsory financial charge or some other type of levy imposed on a taxpayer by a governmental organisation in order to fund government spending on various public expenditure. So basically, it's money that's collected from you as a citizen to fund services back to you as a citizen. And how that balances up between the amount of tax that's collected, the amount of services provided, then becomes a hugely political decision, which is way beyond the scope of today's course. There was also a book written many years ago, I think 1776, by Adam Smith, that's often quoted at university in very technical courses around what tax is. And again, it's just the same thing. The subjects of every state ought to contribute towards the support of the government as nearly as possible in proportion to their respective abilities. So again, it's just suggesting that people should pay tax according to their ability to pay. And income tax is a good example of that. And another quote from Adam Smith is that each individual, the amount of tax they should pay ought to be certain. The time of payment, the manner of payment, the amount to be paid ought all to be clear and plain to the contributor and to every other person. So whether our tax system is certain and clear is again a whole other political conversation, but those are the basic principles of good and fair taxation, really. So how do we pay tax? We often just think about paying tax on our wages, what gets deducted when we work as an employee, the income tax and national insurance that we pay on our wages. But that's just part of a whole spectrum of taxation, really. We also pay tax when we're in business. We pay income tax and national insurance if we're self-employed. If we run a limited company, we pay corporation tax and dividend tax on the income that we draw. When we buy goods and services, we pay VAT, that's a tax. When we invest our money, our capital, we receive rental income, we receive interest, we receive dividends, we pay tax on the growth, on the return that we have on that investment. The capital itself, when the house prices rise, when the share prices increase, we pay capital gains tax on the growth of the capital itself. And then finally, when we die, we pay inheritance tax, or our beneficiaries pay inheritance tax on what we leave behind to them, subject again to various tax-free allowances. So I think the saying is, there's nothing as certain in life as death and taxes. And I think that just about sums it up. So I thought we'd start just by covering the different ways in which you can pay tax, the different ways that you can earn money and the different ways you pay tax and the administration of those different ways. So we start quite simply, is probably what we're most familiar with, is being an employee and what taxes we pay as an employee. So we all have a personal allowance for the current tax year and now frozen through until the tax year 25-26. We're all entitled, and this is for self-employed people as well, actually, as well as being an employee, we're all entitled to earn £12,570 at the moment of income without paying any tax. Just so, again, that progressive nature that the low earners don't pay tax. When we're an employee, we then pay income tax on earnings above this level. Where we're a basic rate taxpayer, we pay it at 20%, higher rate 40%, and if we're lucky enough to be additional rate taxpayers, we pay at 45%. We also pay national insurance, which is, it's not technically a tax, but comes off your wages as if it is a tax. And there are two types of national insurance. As employees, we pay 12% on our earnings out of our net pay, and our employers also pay 13.8% on the total on our gross pay, and they pay both over to HMRC on our behalf. You may be aware from recent news coverage that there is going to be a health and social care levy of 1.25% introduced into national insurance from April 22. So that will increase the employees' rate from 12 to 13.25% and the employer's rate to 15.05%, excuse me. And we'll see on the next couple of slides how that impacts in take-home pay. As we said, all this is deducted by your employer before it hits your bank account, so you don't really need to worry about it when you're an employee. There are various different ways that you can save tax as employees. You can make pension contributions, which as a higher rate taxpayer can be a really useful way to save tax, and we'll cover that on a slide further on in the presentation. Gift aid payments, you do get tax relief for making donations to charities. And salary sacrifice, again, which we'll cover in the context of pension contributions later on, can be a useful way to save tax because it reduces your gross salary. So not only does it save tax, it saves national insurance as well. Employment expenses are a useful way of making sure you're not paying more tax than you need to. They are quite restrictive for employees because you have to meet 3 criteria. You have to be wholly, exclusively and necessarily for the purpose of your employment, and necessarily really narrows down that definition. But there are things like subscriptions, mileage claims, work from home claims at the moment, that uniform costs, etc., that can all be claimed, and we'll cover those on a future slide in a bit more detail. You can obtain the tax relief for the above either through your tax code by ringing HMRC to adjust it, or by completing a form P87, or in certain circumstances you need to do a tax return. Again, it's very much dependent on individual circumstance. And it is possible that you end up paying too much or too little tax through pay as you earn. And in order to reconcile at the end of the tax year, if you have over or underpaid, HMRC will deal with that via a form P800. If you owe them tax, they will send that out pretty promptly. If you think they owe you tax, that will be a little slower, and it's probably a good idea to chase that up yourself. Either give them a ring or check out your personal tax account. But you'll definitely get it quicker if you chase it up yourself. So the next couple of slides, we'll just run through these quickly, just to show the impact of this health and social care levy of 1.25% on an employee that has gross pay of 30,000, and on the next slide of gross pay of 60,000. So again, very quickly, you can see that the employer's national insurance contribution will increase for this individual by £265. That's paid by their employer, not the employee themselves. And the employee's national insurance, which the employee will pay, will increase by £255. So not only has their net pay reduced by £255, but the cost of that individual to their employer has increased by £265. So which may impact on staffing budgets, pay increases, etc. So ultimately may have an indirect impact on you. For a higher rate taxpayer earning £60,000, you can see those figures increase to £640 for an increase in employers and £630 for an employee. So quite, that person's going to see quite a chunky reduction in their net pay on a monthly basis. So the next structure in terms of receiving income, etc., and this is is a self-employed individual or is a sole trader. The two terms are interchangeable, they're the same thing. And these are generally the structure for somebody that's in business and in business on their own account. And again, we'll just cover the basic taxation and administration of being a sole trader. The first thing that's important to remember is the business is you. In law, there is no distinction between you as an individual and your business, which can have an implication for liability should anything go wrong with the business. And we have the personal allowance that's available for a sole trader, and above that you pay income tax at 20%, 40% and 45%, just as you do as an employee. National insurance is slightly different, however. At the moment, above a national insurance free threshold of about £9,500 at the moment, you pay 9% if that falls into the basic rate threshold for national insurance, and above that, above 50,270, you pay 2% in class 4. Again, that will be impacted by the health and social care levy, so those rates are again going to increase by 1.25%, as you can see on the next line. As a sole trader, you also pay class 2 national insurance, which is the old-fashioned stamp you may hear referred to, and that's £3.05 a week, £158.60 a year, and that is collected through your tax return. You don't actually pay that by direct debit anymore. That's paid through your self-assessment tax return. It's the tax return, one tax return that you submit to HMRC on an annual basis. And I've given some dates there just because I think having actual dates brings it to life a little bit. So if you began as a sole trader today, you're doing that in the 2021 tax year. That tax year ends on the 5th of April 2022. And any tax that is due on any income that you've earned throughout that tax year is due to be paid to HMRC by the 31st of January 2023. So as you can see, quite some time in the future from starting to trade in 2021. Interestingly, you don't have to register for a tax return until the 5th of October after the tax return has ended. So one of the common questions is, or common fears, is that as soon as you start to trade, you have to register with HMRC or HMRC are going to get you. That's not quite true. You have until the 5th of October 2022, in my example, to register for a tax return. So you've got time to even check out whether it is actually going to work out for you before you have to register formally with HMRC. And that tax return is also due by the same date that the tax is due, by the 31st January 2023. So you do have time. You have 10 months off the tax years ended to sort the tax affairs out. And it really is, in terms of tax administration, as simple as that. It's just one tax return that has all your sources of income on. So your employment income, if you have it, your sole trader income, etc., plus rental income, dividends, interest, etc., all goes on that one document. And it is as simple as that. There is, in terms of tax payments, there is a potential for payments on account to be payable twice a year in January and July. That only applies if your tax liability is greater than £1,000. Can be a bit daunting to have to pay 150% of your tax bill on that first payment, and then again 6 months later. But as I always say to my clients, if you start saving the right amount of tax from the very first invoice that you raise, you should have enough tax to pay those payments on account, and they shouldn't be as scary as what they sound. And I think it's also important to add that this applies for side hustles as well as operating as a sole trader for your own business. The tax rates apply, the deadlines apply, the administration applies. So it doesn't matter whether you're doing a little bit of something as well as working or a sole trader. It is all of your sources of income. The same rules, deadlines, administration applies. Again, there is one of the common questions is how do we save tax? So again, pension contributions and gift aid contributions are useful ways to save tax for higher rate taxpayers, and expenses are obviously really important in terms of saving tax, and they are more generous than they are for employees because we only have to prove that they are wholly and exclusively for the business. And again, we've got a slide further on to just go into expenses in a bit more detail, so I'll not repeat that now. And again, the next two slides, I just wanted to demonstrate the impact of the health and social care levy on profits of £30,000 and £60,000. And again, really simply, you can see that there's the exact same amount, £255 for that individual. And £630 for the taxpayer that's earning £60,000 of profit. So the other option we have in terms of running the business is a limited company. And I think that, again, is a commonly asked question. Should I have a sole trader or should I have a limited company? So we'll just go through the administration of a limited company. And again, the first thing that's really important to remember is a company is a separate legal entity and a separate reporting requirements. So I've got two slides on this. The first one concentrates on what the company has to do, and the second one focuses on what you as a director and shareholder of that company need to do as well. But that is a really important distinction just to keep in the back of your mind, that separate legal entity. And that gives you the limited liability protection against debts, etc., that you might have come across in terms of a company. The company is liable for its own debts. So if the company can't afford its debts, then the debts die with the company effectively. So because it's a separate legal entity, a limited company pays its own taxation, which is corporation tax. That at the moment is 19%, but from April 23, that is going to increase. It will stay the same for profits less than 50,000 at 19%, and where profits exceed 250,000, the rate becomes 25%, and profits in between that taper. The rate tapers between 19 and 25%. It effectively creates a marginal rate of 26.5% between those two ranges, but that is a bit techie. So as well as paying its own taxation, a company also has to file its own accounts at Companies House, and they are on public record, although there's very little information on there. They have to be filed no later than 9 months after the end of the accounting period. So again, to put some dates to it, if the accounting period was the end of December 21, those accounts were due to be filed by the 30th of September 2022. Slightly different in the first year, it's usually a little bit earlier, but again, that date is available on Companies House and is easily accessible. The company also has to file its own tax return called a CT 600 at HMRC, and that has to be filed 12 months after the end of the accounting period. So same year end, December 21, the CT 600 has to be at HMRC by the 31st of December 2022. And something's gone a bit wrong there, Katie, that's not the right that's the self-employed page.
How strange.
Yeah.
Sorry about that, Nicola. I'm not quite sure what happened. Do you want me to whiz on to the next slide for you, or do you want to?
Yeah, I think the last bit on there was just that we would pay the tax 9 months and 1 day after the end of the accounting period. So if it's an accounting period ending 31st December 2021, the tax will be due to be paid at HMRC by the 1st of October 2022. So the tax deadline and filing deadline pretty much coincide. Let's try the next one.
Yeah.
So the next key point is the company has paid its taxes and it has taxed profit left in the company. At that point, that money is still the company's, it's not yours. And we have to work out how we're going to get that money out and into your hands to pay your bills and enjoy yourself. So firstly, we start with a director's salary, which at the moment we set around £737 a month for a few reasons. It's a wage, just in the same the wage you get as an employee. So it uses your personal allowance. It's tax deductible for the company, so it saves you corporation tax. And it also gives you national insurance benefits. So again, we've referred to that stamp for national insurance. That's really important to maintain your right to state pension, SMP, SSP, SPP, all those kind of contributory national insurance benefits. So having that salary, reporting it to HMRC retains the right to those benefits for you. And then any income that you need over and above that, we tend to distribute as a dividend. And a dividend for a small limited company is just the same principle as a dividend if you were a shareholder in BT, BP, Royal Dutch Shell, etc. And they can only be distributed where we have profit available, so you can't create a loss for the company with the dividend effectively. And in terms of the personal taxation, again, you have the personal allowance of 12,570 that can be topped up with dividends. We all have a £2,000 tax-free dividend allowance, and then above that, where the dividends fall into basic rate, we pay 7.5% at basic rate, 32.5% at higher rate, and if we're lucky enough to get into additional rates, it's 38.1%. And again, with the health and social care levy, we're seeing that increase to 8.75%, 33.75% and 39.35% from April 22. But a company is flexible, and it gives us the opportunity to time things in the most tax efficient way, and also potentially use a spouse as a shareholder to utilise that dividend allowance of theirs or the basic rate band that they may have unused if they are unused. Again, this dividend tax is paid through a self-assessment tax return, and the deadlines are exactly the same. If a dividend arises in the tax year 2021-22, which we're in at the moment, any tax on the dividends is due by the 31st of January 2023. The tax return is due by that date. And again, if we need to register for a tax return, it's the same deadline, the 5th of October after the tax year has ended. And the tax on the tax return is due by the 31st of January 2023. And the payments on account system that we've briefly discussed applies as well for dividend taxation. So I guess the basic principle is the tax return just deals with all these different sources of income. It just depends on what income you have, what taxation applies, but the administration of it.
Can I just jump in, Nicola, really quickly? We've just had an anonymous question just for a little bit of jargon busting, just asking what a dividend actually is. So I thought that'd be a good point to jump in for you to explain that one.
Yeah, a dividend is a distributed profit by a company. So it doesn't matter what company it is, whether it's a listed company on the FTSE 100 or whether it's a small private company. It's basically distribution of profit to its shareholder. And HMRC treat that as investment income and is taxed as a dividend under these dividend tax rates that apply.
And someone's just popped in the chat box as well. These shareholder dividends, is it the limited company that pays the income tax or the director?
The director, so it goes on the personal tax return, is added up to all your other sources of income. So if you've got a salary, if you've got a sole trader business, if you've got dividends, it all goes on that personal tax return. It's all added up together. Various different calculations are done by the computer, and then it throws out the tax bill for that individual. It's the corporation tax that's payable by the company, the dividend tax that's payable by the individual. And apologies for the jargon, it is a different language, I appreciate that, and I do try and keep it as clean as possible, but these words do, yeah, it is jargon. Generally we see most tax savings are available through the company, so there's various different ways that we can save tax through a company. We've got those expenses that we can claim off the company, where they're wholly and exclusively for the benefit of the company. So we can have mobile phones as tax-free benefits. We can sometimes have company cars if it's a tax efficient thing to do. The company can pay pension contributions. We can claim for using our own home as an office. The company can buy assets that we can use. So if we need a laptop or if we need an iPad, the company can buy it, and then as a director, shareholder, owner of that company, we can have some private use of that without any tax consequences. So what we try and do with a limited company is get the company to pay for as much as we can, as long as it's allowed to, and that's a really good way to utilise that company's money.
We've just had another very quick question coming in on the dividends front as well, just while we're jargon busting, Nicola. I appreciate it's definitely lots of technical words, that thank you for making it as clear as you have so far. They've just sent me an anonymous question just to say, so do you automatically have these dividends, or do you have to buy them like shares?
No, you own the company. You have when you set that limited company up of your own, you are a shareholder. Just as in the way that you might buy shares in, for example, and receive dividends, you do effectively buy shares in your own company, but genuinely we just buy them for £1, and then the dividend is that return on the investment, if you like, as a distribution of profit for the company. It's this the principles of dividends are just exactly the same from a PLC as they are for a small limited company. They just kind of evolve a little bit differently.
Yeah. So I guess because I know when you do my accounts, Nicola, for example, I'm paying that £737 as a wage, and then when I pay myself more, that quite often gets counted as a dividend when the tax return goes through at the end. So I pay myself that, and then that gets told as that was dividends taken out of the company. I hope that makes a little more sense. I realise it's a lot for people to take in, isn't it?
Yes, it is. And hopefully this next slide just goes through the calculation. Hopefully that will kind of, I know it's sometimes easy to see numbers or dates written down rather than just visualising it in your head. So again, we're going back to that business that's earning £30,000 in profit. And the first column before is a taxation as it is now. And the after column is the taxation, including this 1.25% levy, just again to demonstrate the impact of that. But in terms of profit extraction, we'll go through the before column in a bit of detail. So again, this is a business that has profit of £30,000. This director is taking a salary of £737 a month. So the annual salary for them is £8,844. That is what we call tax deductible. So we take that off the 30,000 and are left with taxable profits of £21,156. And it's that figure we times by 19% to get the corporation tax. So you can see if we just applied 19% to 30,000, it'd be a lot more than £4,020 of the tax bill. We then take that off the profit. So we've got profit of £21,156. We've paid tax of £4,020, and we're left with what we call distributable profit of £17,136. And to cut the jargon there, it's after tax profit. So it's the profits that's left in the company after it's paid all its taxes. And that's what's available to distribute or to give to the shareholders as a dividend. And the maximum in this example that you can give as a dividend is £17,136. No more, but you can give less. Again, how much you draw is flexible and depends how much you need to live on, basically, or how much tax you want to pay. The dividend tax on that dividend, what we do is we add up the salary and the dividend. So we get total income for this director shareholder of £25,980. Pop that through the tax calculator. They pay dividend tax of £856, which is what goes on their personal tax return, and they pay in the self-assessment system. And after they've paid all that, they're left with £25,125 of taxed income, which is equivalent to that bit that you get in the bank when you're an employee. That's what you've got left to spend after you've paid all your taxes.
Just a really quick one. Sorry, Nicola, to interrupt again. It's just very relevant to where you're at the moment. Somebody just asked, can we just go over why £737 a month when it doesn't reach the 12,570 of non-taxable income? That's to do with the national insurance stamp, isn't it?
It's to do with the national insurance limits. It equals a maximum that you can pay without paying national insurance. So £1 more would trigger employers' national insurance. And we can pay more, but this is a rate that we set, which is the most tax efficient. So we're getting the benefits of having paid national insurance without having to pay any, which is why if we increase that salary to £750, we'd have a employer's national insurance liability, potentially an employee's national insurance liability, that we'd have to pay over to HMRC every month when that salary is processed. So again, from an administrator, we can increase it to 12,570, and some accountants do, but we stick at that £737 limit because it is tax efficient to do it that way. And also it saves a hell of a lot of administration. You don't want to have to, as well as everything else in your business, have to remember every month to pay an amount of pay as you earn over to HMRC. It's a hassle that you can do without, really. So that's the reason for it. We don't always pay a salary. If we've got a portfolio career, you might be employed and have a limited company on the side. If you're getting those national insurance benefits from elsewhere, from employment, or even from child benefit, or from a self-employed business, for example, we might not pay a salary from a company because, again, the administration of doing that outweighs the benefits of doing it. So the principal reason for doing that salary is to make sure that we're retaining the rights to our state pension, really. Because you do need a considerable number of years to qualify for that state pension, so every year counts. That answer you?
Amazing, thank you. Yep, we've got some thanks come through anonymously as well in the chat box, so thank you, Nicola, that's brilliant.
So the after column again just demonstrates that in this example, the health and social care levy will just cost this taxpayer another £143 a year, so less than being an employee or a sole trader. Again, my next example is back to that £60,000 profit. And again, with time in mind, I'll not go through that calculation in detail again, but I'll just pick out the highlights. The taxable profit for this individual or this company is £51,156. So from April 23 will be affected by the increase in corporation tax rates. So that's going to cost them an extra £86, which means that the dividend they can pay out to the shareholder is £86 less than before. And then the dividend taxation, because it's throwing them slightly into higher rates of tax, and we've got this levy, is going to cost them an extra £436 in dividend tax. So before this levy and the increase in corporation tax, this person earning £60,000 of profit in their company would have taken home after tax £47,600. And after these tax changes, we'll take home £523 less, just over £47,000. So that just kind of demonstrates the impact of this levy and corporation tax increase on a relatively small business, really, in the grand scheme of things. I wanted to cover IR35 very quickly, and as Kate said at the minute, some of this could be an entire webinar on its own, so I am really going to cover this at a very high level, just where it impacts the decisions you might make around what you do. So IR35 is around employment status. It's basically around contracts between customers and suppliers, where even if it is with a limited company, the underlying relationship is one of employment, if you took away that intermediary. And then if HMRC under this legislation deem me to be an employee, then they want to apply employment taxes, even if it's a limited company. It's very bizarre. If your client, your customer is small, and small, again, is in the definition of audit thresholds, etc. So it actually takes your turnover up to about £10 million. So even a small client can actually still be a big business. It's the responsibility of you as a supplier to deal with that legislation within your company and decide whether IR35 applies, and if it does, pay the employment taxes. If your client is medium or large, which again means that it's got an audit, so in the veterinary world, it would be the large corporate veterinary chains, the large corporate locum agencies. It now from April 20 becomes their responsibility, so your client's responsibility, to assess whether there's employment status employment relationship applies, and for them to deduct taxes. So again, it's very bizarre, but what you end up in that relationship is your invoice being paid net of employment taxes. There are different options of how to deal with this. And I think the last point is probably the most important point, that this choice is often driven by your client, by your customer. You know, Katie and I have discussed that some of the big corporates, some of the locum agencies just won't deal with limited companies anymore. They will only deal with umbrellas, they will only deal with employees. So often the choice is taken out of your hands and is driven by your client. I just noticed a question in the chat box. I mean, the client being the veterinary, the customer that you're invoicing. So if you're a locum, it's the veterinary practice that you're working for. That's what I mean by client. And supplier, I mean you, effectively, the limited company. So in terms of dealing with IR35, you do have choices, again, choices driven by your client / customer. You can go on the books as an employee, pay the same taxes, but have the benefits of having employment status, employment rights, employment obligations. You can continue as a limited company and have the IR35 dealt with on your behalf. You can go through an umbrella company. And again, all the taxation will be dealt with on your behalf by the umbrella company. And we'll come on to that on the next slide. But as I said, this is often taken out of your hands and is dealt with where there's a medium or large customer / client. It's often what they deem that they will deal with based on their assessment of the legislation or the rules. So an umbrella, again, I'm going to cover this really quickly just in the context of IR35. An umbrella company is a large organisation that basically acts as a conduit between the client and the worker, effectively, and deals with the payment and the taxes on behalf of both organisations. It should deduct pay-as-you-earn taxes, so the umbrella should deduct income tax, employers' national insurance and employees' national insurance. Again, it should all be deducted by them, so what you end up with in your bank account is taxed money in the same way as if you're an employee. An umbrella company will also deduct other things from that payment. They'll deduct an admin cost, they'll deduct employer pension contributions, they'll make a provision for holiday pay. For some of them, they'll also include an apprenticeship levy if the size of the organisation means they have to pay that. Again, it's generally used for temporary or agency workers where the end client doesn't want an employee, they just need somebody to do a job for a temporary period, so locums. An umbrella can be used as an alternative for a limited company. You've got costs and fees of both. And again, as we've discussed in the context of IR35, that decision might be taken out of your hands anyway. And the last point to make is there has been a lot of tax planning and around umbrella companies where they've given loans or dividends, etc. And HMRC are very aware of these organisations and structures. And I think the take home is if the take home pay that the umbrella is going to pay looks too good to be true, it probably is. And HMRC are investigating some of these umbrella companies. And I've got a client myself where the umbrella companies come on their radar and they're now after her. And she's got to prove that she's paid the appropriate taxes on the income that she's received from this umbrella. Side hustles, again, this is a common thing I get asked from the veterinary community about side hustles. What do you do if you have a bit of a business going alongside being employed or doing locum work, etc. I've put sole trader or self-employment. You do have a choice in that structure. You could have a side hustle as a self-trader, or you could have a side hustle as a limited company. There's pros and cons of both. But I'm going to focus on quite a small side hustle here, which you'd probably go down the self-employment route with. Again, the taxes, as I discussed on the previous slide, are the same as being self-employed as your sole source of income. The deadlines are as the previous slide. The side hustle just goes on your tax return with the other source of income that you have. What's particularly relevant for side hustles is a trading allowance that we now have of £1,000. And effectively, it's a tax-free allowance of £1,000. So if you've got sales less than £1,000, what HMRC are saying is you don't need to declare it. it's a de minimis for them. They're not interested because the administration of dealing with that level of sales and tax is greater than the benefit to them. It's also an allowance in terms of an expense. So you can, if you had sales of £2,000, you can deduct the £1,000 trading allowance and pay tax on £1,000, which just simplifies administration again. Or you don't have to do that. If you had expenses of £3,000 and a loss of £1,000, then you'd obviously use the expenses of £3,000 and create that loss. So it's an optional choice. Another important slight differential with the side hustle is if you have another source of income, such as employment that is using your personal allowance, is used in your basic rate band, then your side hustle will come straight into taxation at what I call your marginal rate of tax. So if you're a basic rate taxpayer and your side hustle falls within basic rate, straight away you'd pay 20% income tax on it. If you're a higher rate taxpayer, your side hustle will go straight into 40% income tax as well. Portfolio career, and again, another common question is, yes, it is possible to have employment income, self-employment income, umbrella income, or IR35 income and a limited company all at the same time. Keep extremely busy, but from a tax perspective, it is possible to have 1, 2, 3, or 4 sources of income all at the same time. What I would say, though, is if you do have multiple sources of income from multiple different structures, is that more careful planning is required. Some of the things that we've discussed, such as a salary for a limited company, may not be useful for you in that circumstance. So you just need a good accountant that will look at your situation holistically and come up with the best options for the different sources of income. Expenses. So we can consider expenses in the context of being an employee. And as we've discussed, there are a limited number of expenses that you can claim as an employee. So memberships is a good one, particularly for professionals such as vets. So your professional subscriptions that you have to pay, if they're not reimbursed by your employer, deductible against your employment income. And you can get that via a P87, a tax return, or amending your tax code. And there's a link there to I think the VetU website, isn't it, that gives you a list of all the different memberships that you can claim. Uniform costs and maintenance. Again, if you work in a veterinary practice and you have to clean your own uniform and provide your own uniform, then that's necessary for your employment and you can claim that as an expense. Mileage is a good one. If you have to travel and you're not reimbursed by your employer, you can claim mileage back on your tax return. It's obviously better to be reimbursed. You'd rather have 45p a mile than the tax relief and 45p a mile. So try and get it back from your employer first, but if all else fails, you can get tax relief for it. We then kind of go on to more expenses that are not allowable really for an employee. These are more for self-employed businesses or limited companies. We can claim for costs of mobile phone. We can buy computer equipment for the business, professional equipment, so if you need medical equipment, etc. That's okay. Accountancy fees are fine for self-employed individual or a limited company. Stationery, office equipment, printers, postage, and in this days, digital subscriptions, things like that, computer costs. Books and publications, again, for a self-employed business or a limited company. If you need to do training, you need journals, study books, etc. That's all fine. Pension contributions are not necessarily an expense, but you can get tax relief for pension contributions. Working from home, this is one for employees and self-employed and limited companies. This became more generous during COVID because more people were working from home, and that has increased to £6 a week. And we can get tax relief for that in all 3 different options. And then mileage, again, that's suitable for employees, sole traders, limited companies, and is really quite a valuable claim. If you did 10,000 miles at 45p a mile, that's a £4,500 tax deduction that you can claim. So And it's not just mileage to clients, it's mileage to suppliers, to the bank, to see your accountant. Any journey that you do on business is part of that mileage claim.
Can I just quickly, Nicola, whip through 2 questions that we've got that are relevant that we've got on there for expenses. One of them really quickly. So can you claim a uniform back even if you're an employee only? That's the first one.
Yeah, you can, and the costs of laundering that. So again, doctors, nurses, vets, if you've got to go home and use your washing machine to launder that uniform so you can wear it the next day for work. And yeah, there are fixed rate expenses. And again, I think on the VetU website, you've got a list or a link to HMRC website of those fixed rate expenses for different professions.
Yeah. And the second one was, as a locum, how many hours could you claim working from home for the purposes of emails and contacting practices and agencies?
Well, it's the actual amount that you work from home. So HMRC would suggest that you should just keep a record of how many hours you work from home. There is for self-employed individuals, it's not quite £6 a week. There's a again, if you Google benchmarking work from home, there's a HMRC website, which again, we can pop the link. I can send you the link, Katie, for the VetU website, that just states how many hours you work in as a self-employed individual at home to how much you can claim. The £6 a week is really for a limited company and an employee. Brilliant. But in terms of the employee and limited company, there isn't a minimum number of hours. If you're working from home, you're working from home and you can make that claim.
Super, thank you.
I just thought it was worth covering off pensions, because I think this is quite a misunderstood way of obtaining in tax relief, particularly for higher rate taxpayers. So they are useful tax planning for basic rate and higher rate taxpayers. And I think it's important to remember, even if you are a basic rate taxpayer, so you're just paying income tax at 20%, 20p in the pound, for every £80 that you put into a pension, the government will top that up by the basic rate of tax of £20. So your pension fund receives £100 to invest on your behalf. The pension scheme is a tax-free environment, so the pension scheme isn't paying tax on that. And then we'll come on to ways that you can extract it tax efficiently. So actually that £80 that you're putting in can really work quite hard for you in a pension. For a higher rate taxpayer, there's additional tax relief available. Again, for that £80 that you put into the pension, the government will top that up by £20. But then on your tax return or through your tax code, you can then obtain what we call the higher rate tax relief. So a further £20, which is the other 20% tax relief, which then reduces your tax bill and saves you a bit of money. So you've still got £100 in your pension pot, but you've got £20 back from the government as well. So that £100 pension contribution only cost you £60 in your pocket. But again, that £100 working hard for you in a really good tax-free environment within your pension fund. That works if you pay that pension out of what we call your net pay. So after you've paid all your taxes, if you pay a pension contribution, the tax relief works like that. But an alternative to that is what we call salary sacrifice. And salary sacrifice does what it says on the tin, really. You sacrifice your salary, you reduce your salary in order that you ask your employer to pay an employer's pension contribution on your behalf, equivalent to that salary that you've given up. That can be quite useful because it means your gross salary is lower. So, for example, if you had a £30,000 salary and your salary sacrifice £1,000, your employer would put £1,000 into the pension scheme for you, and then you would have tax, national insurance, and student loan contributions calculated on the lower £29,000. So not only are you getting an income tax saving, you're getting a national insurance saving and the student loan saving. So salary sacrifice is worth thinking about as well in terms of pension if you're an employee. And then again, we've discussed that money for a pension is in a tax-free environment, it's growing, it's working in a tax-free environment. You can't access the money until you're 55 or potentially 57 in a few years' time. But it's working away there. It's well, this is what VetU is all about. It's providing for your future, being financially savvy. And then when you do retire, you can take 25% of that pot tax-free, and then the remainder you draw at your marginal rates of income tax whenever you're drawing it in your retirement, so 20, 40 or 45%, depending on how much pension you have at that point. So again, a really tax efficient way of getting the money in, the money to grow, and then to get the money out as well. So pensions are really, really attractive and worth it.
Super. And I'll just really quickly jump in at that point, Nicola. I mentioned that next Tuesday we have a pensions event specifically about pensions, where we're joined by a financial advisor and a flexible online pension company as well. So Nicola's very kindly covered the tax side and how it's efficient on that front. And if you want to know more of the ins and outs, then Ebony has popped a link in the chat box to sign up for that, because it's always a really good session, and I know people get a lot out of it. So
pensions are really important. Really thinking about
our future fund, that's what we keep calling it.
And the earlier you do it, I mean, I don't want to encourage on financial advice, I'm not allowed to, but again, the earlier you do it, the more you'll be grateful for it when you do come to retire. Yeah. I should add, in terms of tax, that because they are so generous, there is a limit to how much you can have tax-free. You are allowed to save a maximum of £40,000 a year. Again, the pension rules are really complicated. This is a really simple oversight of pension taxation. This is much more complicated, but in general principles, most people can save £40,000 a year, although it is restricted to the amount of, as an employee, the amount of earnings you have. So if you were only earning as an employee 25,000, you could only contribute 25,000. But if you had a limited company that was doing really well, that earnings limit doesn't apply. You contribute £40,000. There is also a lifetime saving limit. So if you do have a really excellent pension, you can have, over a lifetime, you can save £1,073,100 in a tax-free environment. But just to bear in mind, that's not the amount that you contribute, that's the value of your fund. So if you put in 800,000 and it grows by 50% and it ends up being worth 1.2 million, it's that 1.2 million value that you compare to that limit, not what you contribute. But to be very fortunate position to be breaching those limits. So I just wanted to finish on just a brief update of what's new in tax, and also what we're expecting to change in tax perhaps over the next few years. So we know about the health and social care levy. We've discussed that throughout the presentation. It's 1.25% on national insurance and dividend taxation, and that comes into play from April 22. Again, we've discussed a potential increase in corporation tax. Again, this will only affect limited companies and unlimited companies where profits exceed £50,000, but worth bearing in mind. We also have something called a super deduction for capital allowances. And this is really difficult to explain briefly without using jargon, but effectively for assets that you buy, so computers, things like that, at the moment, you can get tax relief of 100% of that cost. This super deduction is a COVID response, but effectively gives you tax relief on 130% of the cost. So you're getting a 30% uplift on your cost in terms of tax relief. So it's designed to stimulate investment, big corporate investment in large companies, but will apply as equally to small companies as well. We know the working from home allowance has been increased to £6 a week. Again, that's been a COVID response in relation to the increase working from home. Mortgage interest relief for buy-to-let landlords has changed significantly over the last few years. And again, there's a huge amount of detail around this, but it effectively means that for buy-to-let landlords, the amount of tax relief you get for your mortgage interest has drastically decreased over the last few years. Again, that's just relevant to buy-to-let landlords. Again, for buy-to-let landlords, if you are selling a property or if you have a second home, you have to pay capital gains tax when you sell. We have to report that within 30 days and pay tax within 30 days. So again, if you have a property, talk to your accountant before you complete on the sale, and they'll advise you what to do. Electric cars. This is my favourite subject at the moment because I've got an electric car. They are quite tax incentivised at the moment. So in terms of employment, if you can salary sacrifice or have a company car that's electric, if you've got a limited company, you could run an electric car through a limited company, and they're really tax incentivized at the moment. So I'll give you an example. The P11D value of my car is 39,000 and it's taxed at 1%. So the value of my tax, if you like, for that car is £290 a year. Times that by 20% income tax, and that car is costing me £78 a year in tax. It's insane. It is going up to 2% from the next tax year and 2% for the following tax year. But the government have set out that taxation regime up until the end of March 24. It is a carrot to incentivise electric cars onto the roads. So that will change. As soon as there's enough electric cars on the road, the taxation starts to drop, those rates will increase. But while they're so low, it is a really useful thing to consider if you want an electric car. And I love mine, it's brilliant. So that's what we know is happening at the moment. And we're always thinking, as tax advisors, what's coming next? What do we need to prepare our clients for? We have a budget statement on the 27th of October. And generally there's quite a bit of gossip about what might crop up. At the moment, we're thinking the health and social care levy has been the big thing. It's a big tax increase, affects a lot of people. So we're thinking maybe that might be it. Who knows? The key thing to think about in the context of what we've just been talking about is making tax digital for self-assessment. We already have making tax digital for VAT. So if you have a VAT registered business, you should already be aware of this. But from April 24, and that date is now in legislation, from April 24, making tax digital will impact sole traders and landlords where their income and their sales, it's not profit, it's sales. So the rental income or the sales is more than £10,000 a year. And again, this is a whole other seminar on its own, but in very high level, just basically means that HMRC want records to be kept digitally on cloud accounting software generally, and they will want quarterly reporting. So rather than one tax return every year, they want quarterly reports and then an annual reconciliation at the end of the tax year. So just something to bear in mind, and certainly worth considering a webinar at some point on that Katie, I think, to cover the detail. And then other speculation, which we've had for a number of years, is an increase in capital gains tax, which then just affects people probably with property or stocks and shares portfolios. There's been talk about increasing the rates on those to be the same as income tax. We've been talking about reforming inheritance tax for years. Maybe that will happen. Pensions, again, we've been talking about reforming pensions for a while because HMRC do consider it and the government extremely generous. Green incentives, we've just been talking about company cars. I'm sure with the climate change agenda, there'll be a lot more incentives to incentivize people to go green. And then I've just mentioned the budget statement. We think potentially it's going to be more technical announcements rather than big headline tax rises. Now we've got the health and social care levy, but that doesn't mean that doesn't mean you're going to pay more tax. The freezing of the personal allowance is a great example of that. If wages go up and the personal allowance stays the same, we end up paying more tax by stealth. And the tax avoiders is a big topic for HMRC. They're after closing the tax gap, so there'll be lots of probably little ways of closing and catching those that aren't paying the tax that they should do. I think that's
super. Thank you so much for that, Nicola. There was so much to take in, but you covered so many things. And like you said already, they could have all been separate sessions in themselves. So thank you for giving us that top line view of everything. I'm very aware of everybody's time. I know that we covered a lot there. So what I was going to do is really quickly just whiz through and do our signposting for anyone that's on the call that would be interested in booking in with Nicola, that wants to know more about what VetU does. And then we'll get you thinking about what you're all going to do now as a result of now being a bit more tax savvy and being a bit more aware of everything. And if we've got time, and if Nicola, you're happy, and we can whiz through a couple of questions at the end. I think you've covered the majority of them in everything that you've talked about already. And we realise this is everyone's precious time and yours as well, Nicola. So we don't want to end up keeping everyone too long when you showed up and got so much valuable information already. So I'm going to whiz quickly past these and we'll come back to them and just signpost you all for some important bits while you're all here. So first of all, for VetU, we have put together a fantastic digital delegate bag that's got loads of actionable steps, downloads, videos, financial information, education, because that's what we are so passionate about helping you with as vets and as nurses. So you can check out that. Ebony will put the link in the chat box as well. We'd love to know what you're going to take action on as a point of listening to this evening as well, because yes, we can listen to information, we can take it all in, we can leave it till next week or the week after, but what is the one actionable step you're going to take tonight? Is it going to be to book in a call and speak to Nicola, submit your details, which you can do here by typing in bit.ly/taxvetu? Or is it that you're going to sign up to the pension event next week? I know we've had some bits in the chat box saying we know that our next step for this will be to sign up for the event and get started soon. And I know that the rest of the VetU team will agree that from previous pension events, that has always been one of our big conclusions, has been start now, rather than waiting any longer as well. So before I whip back to those questions and see, Nicola, if you're happy answering those, I'm just going to pass over to Matt briefly to do a little bit more of a wrap up from the rest of the VetU team as well. And then we'll come back. And if anyone does want to stay on, and if you're happy, Nicola, we'll just answer a couple of those questions that I think we've covered the majority of them.
So yeah, I just, on behalf of VetU, just wanted to say thank you, Nicola, for joining us tonight and giving us such an in-depth and very broad-ranging and important talk. As you pointed out, there isn't anything as secure in life as death and taxes, which is something that Benjamin Franklin, one of the US presidents, first coined. But little did you know that he also coined the term time is money. So, and I know that everybody has voluntarily given their time up tonight, and hopefully there's going to be a financial return for them from the knowledge they've gained for joining us today. And the other interesting fact is Benjamin Franklin was also a little bit of an entrepreneur. So as well as being a professional person, a diplomat and a politician, he was always having side hustles and dabbling in and out of opportunities. And I think my parting comment is, those of you on the call as veterinarians, veterinary surgeons, you are in a really privileged position that you have the opportunity to jump in and out of our profession without it holding you back from your ultimate goal of being a better vet. So definitely take the opportunity to explore all that the world has for you, but you can only do all of those things, side hustles, traveling and expanding your career, if you've got three things in your life under control. One is looking after your health, two is looking after your income, and three is protecting yourself for the future. And all of those VetU would love to help you with, to help signpost you to ways of making sure those things are secure. So thank you for joining us tonight. If you need to drop off, we completely appreciate that. Thanks to Katie and to Ebony from the VetU team, particularly for pulling together tonight's event. And Nicola, I'll pass over to you in case there's any other questions that people would like to ask you.
Yeah. And we do have a few that were pre-submitted, so I'm going to whip back to them. In fact, we'll not make you all read them all at once. I think we've covered the majority of these anyway, Nicola, but this was an interesting one of, can I charge interest on unpaid or late invoices, which I know you'd got some information for us to signpost towards.
Yes, I think I sent you a link to the gov.uk, Katie, website earlier, and the answer is, in short, is yes. It's more of a legal and commercial matter than it is a tax matter. So yeah, I think just there is information on the gov.uk website.
That's in the chat box now.
Yeah, or there are many debt collection agencies as well. You don't have to go to a solicitor. There's many small debt collection agencies around that will help you and advise on collecting debts.
And we did touch a little bit on cars already, but someone's asked, how am I taxed if I have a company car that I use for personal use? Is it different if I've taken a salary cut for it? And a little bit of the definition on benefits in kind as well, briefly too.
Yeah, we'll start with benefits in kind. So benefits in kind are benefits that you receive from your employer that aren't cash, effectively. So providing with you a car, paying bills on your behalf, paying private medical insurance, etc. on your behalf. And if we didn't have a benefits in kind regime, then what would happen is you'd have a lower gross salary, and your employer would just pay for things for you. So HMRC are very aware of that. So we have this benefits in kind regime, which taxes those non-cash benefits, if you like. So a company, and there's different ways of taxing different kinds of benefits in kind. Sometimes it's just if you've paid a bill on behalf of an employee, the benefit is the amount of that bill that was paid on behalf of the employee. Same for private medical insurance. Your private medical insurance costs £1,000 a year for the employer. The benefit in kind for you as an employee, it's £1,000. And it's effectively, if we go back to that tax return, it's effectively just another source of income. So on your tax return is the gross pay that you have from your P60, your P45, and then this benefit that you have from what we call a P11D. And just add them together and you pay income tax at 20, 40 and 45% on those. There's no employees' national insurance on benefits in kind, but your employer does have to pay employers' national insurance on it. So in terms of a company car, the taxation of that is, for the benefit in kind, the calculation is a bit different. And again, I often talk about tax being a carrot to incentivize you or a stick to beat you with. And the electric cars that we've been discussing is a good example of that. The taxation of that is really generous at the moment because they want to incentivize people to have them. And they want the big CO2 emitting cars off the road, so they tax those to high heaven to stop people having them as company cars. So again, very, very briefly, what happens is you take the taxation of a company car is the value of that car, not what the car costs, the value of it, the RRP of that car. And you'll often see it on an invoice or a lease agreement being the P11D value. And you take that value and then you apply a percentage to it. And that percentage is based on the CO2 emissions of the car. So as I've just described, my electric car, that percentage is 1%. But if it's very high CO2 emitting and diesel, it could be 37%. So there's a huge difference between 37% of 39,000 in my case, or 1% of £39,000 in the case of my car. And that, we'll go back to my electric car. So my benefit in kind is, the value of my car is 39,000, the percentage is 1%. So the benefit in kind to me is £390, the outcome of that multiplication. That £390 is effectively notional income to me, and that gets added to my salary and is taxed at my marginal rate of tax. So if I'm a basic rate taxpayer, that £390 benefit in kind, times that by 20%, and I pay £78 tax on that benefit. And that is, I can't do the math in my head, but you can see that that's a hugely different amount than if it was 37%, excuse me, 37% of that 39,000. That will cost me a hell of a lot more in tax.
That's a massive difference, isn't it? And
the second part of that is, it doesn't really matter if you've taken a salary cut. The calculation for the car is the same. The salary cut just means that your salary sacrificing, so you're giving up some salary for that company car, whereas some employers will give you a salary and a company car. It just depends on the employment package you've got negotiated with the employer, whether you take a salary cut or not for it.
Super. Thank you, Nicola. And I'll just jump in and say as well that as obviously these are all new topics to learn in finances, and these are questions that come up for us. Sometimes we're getting new things we weren't asked last time. One of the big things that we're super passionate about at VetU is helping educate you on finances, as you've seen already. And that's why we get amazing people like Nicola on board too. But we do actually have a community mastermind session that is coming up at London Vet Show. If you are interested in coming along to that, where we're going to get lots of vets and nurses around the table, and we're just going to open the floor to you guys to tell us, like, what do you want to learn about? What are the biggest challenges? You can come and help us create that content. So if you are interested in that, we'd love you to drop us an email and tell us you're at London Vet Show, tell us you're interested. We will save you a spot. There are going to be some good incentives to be there as well. So Ebony will drop our email address in the chat box, and we just thought it'd be a good point for us to drop in, as you explained that so nicely, being another question that comes up that might be keeping someone up at night as well. So like Ebony says, help us create that free educational piece as well. We can't wait to see you all at London Vet Show too. So our next question briefly, and we'll whiz through these ones, I think, because I'm very conscious on time as well, Nicola, and your precious time. Like we say, if you do have specific questions, we've been very pleased to partner with Harris & Co., who they're not the same company as VetU. We've got an agreement in place with them that we work as partners here, so that Nicola comes and gives us fantastic content like this, but we appreciate you're all individuals. So if you do have very particular circumstances, book a call with Nicola. She'll be able to have a chat through with you about maybe coming on board with using Harris & Co. I use them myself, my partner uses them, lots of my friends use them. And all these technical words, terms, dates, etc. I just like the fact that I can leave them with Nicola, and she'll just prod me and tell me when I need to submit things or what information they need from me. And it's been a dream for the last 3 years. So please do, if you do have questions as we whiz through these and you think, oh, I just need to know more, or I'm looking for an accountant, and you're looking for a chartered accountant rather than just someone that says they're an accountant, then you're in good hands with Nicola and Harris & Co. So please do book in. But back to this question anyway, as we go through these quick, Nicola, so we're not keeping you much longer. How much tax should you expect to pay as a locum? I know we've touched a bit on that already. And what is the net pay after, say, a shift that might pay £400?
Yeah, we've covered kind of marginal rates of tax, etc. earlier in the presentation. It's difficult to answer that specifically because it very much depends whether locum shifts are the sole source of income, so whether we view as personal allowances, whether the basic rate taxpayer or higher rate taxpayer, whether you've got student loan contributions. I think the very simplest way to think of it, and the maximum that you would pay, is if you're a basic rate taxpayer, take 20% income tax. We'll fast forward to April, 13.25% national insurance. And if you've got a student loan, add 9% to that. Tot all that up, apply that percentage to the £400, and that's what you'd be left. The minimum you'd be left with. Your tax might be less than that. And if you're a higher rate taxpayer, it's 40% plus 3.25% plus potentially a student loan of 9%. And if you're self-employed, it's 20 or 40 plus the 10.25% or 3.25% national insurance plus your 9% student loan. So I think that's probably easiest way to think about it.
Super. Thank you, Nicola. And again, this has been recorded. So if you want this to go back over this again, as Ebony's popped in the chat box, we'll send this out via email as well. So make sure you're on the VetU list, and I'll see which of these for us to whiz through as well. So I know we've already said about how we declare side income and keep it legal while we're on pay at work. I know we've been through that quite a bit of detail, haven't we?
Yes, yeah.
If you are employed but you locum as well, can you be a sole trader at the same time as being employed, and how do you get taxed? I think we've whipped through that one as well. Starting to locum, which is more tax efficient, a limited company or sole trader? I know, again, we've talked about the limitations and pros and cons, and dependent on what terms and whether the companies that you might be working for will accept limited companies or not. That might be something, again, to talk through with a good accountant, such as Nicola and Harris & Co., and just talk through your individual circumstances, I think. So I'm glad we've covered so many of these already. Any advice on how to calculate buy-to-let income and expenses, or any resources you could direct people towards on that, Nicola, or anything you suggest?
We do have some kind of fact sheets and resources on our website, which again, I'm sure it's www.harrisaccounts.co.uk, which will have various different fact sheets on calculating things like that. Very, very briefly, buy-to-let income is fairly straightforward. You start with your rental income, you deduct all your expenses. Mortgage interest relief goes on a different box in the tax return. Now you get relief differently. And just a couple of things to bear in mind: you can claim for use of home as office for running the buy-to-let business. Mileage, don't forget to claim mileage for the miles you do on behalf of the buy-to-let business. And from tax planning, if it's in your own name and you're married, consider whether having it in joint names will be more tax efficient in terms of utilising basic rate bands, etc. But again, useful to have a chat through with the accountant, really, if you think there's better ways of doing it.
Brilliant. And I've always been so pleased that, because you guys are chartered tax advisors as well, that you always feel safe in the knowledge that you're working things in the most efficient way whilst being as above board as well. So I think, again, we've gone what is an allowable expense, and we touched through lots of those. If you put something through as an expense and it ultimately doesn't end up being allowable as an expense, I think that's a question there. What would happen then, Nicola, very briefly?
Very briefly, it can still go through the company. So entertaining your customers is a good example of something that's not allowable. The company can still pay to take your clients out for lunch, but it would get what we call added back in your tax comp. So again, to put some very simple numbers to it, if your profit was £10,000 and you had £1,000 entertaining your customers, your profit for accounts will be £9,000, but we'd have to add that £1,000 back for the entertaining, and the tax will be calculated on the £10,000.
Brilliant. Thank you. That makes sense. I think it's good to be aware of stuff like that, certainly when you just think, oh, I'll just buy it all in the business, and then realize that actually some of that's going to come back. And then finally, and again, I think we've touched a lot on this one, so I think we've covered it already. What is the benefit of locoming as a sole trader over a 0 hours or pay? Surely you pay the same amount of tax.
You would pay less tax as a sole trader, mainly around the national insurance. You have greater benefit of expenses when you're locoming as a sole trader over being pay as you earn. But on the flip side of that, being 0 hours contract or pay as you earn gives you lots of employment rights and employment benefits that you don't have as a sole trader. So it's just weighing up the benefits and consequences of both. Both scenarios. And as you said, Katie, sometimes the choice is not yours.
Yeah.
It's dictated to you.
Absolutely. Well, thank you so much, Nicola. You've managed to cover so much in the last hour and 20 minutes, and we really appreciate you staying on, and everybody else that's watching as well, staying here and listening to this valuable information that you shared with us, Nicola. And again, we can't thank you enough for coming along and sharing your expertise and answering all those questions, not only at the end, but throughout that as well. That was really, really helpful. And if you do want to watch the recording of this, anyone, you will be able to get hold of that. We will email that out to you. If you do want to book in and speak to Nicola, then please do follow the link that Ebony will put in there. We can introduce you. You can talk through what your accountancy requirements are, and Nicola can tell you a little bit more about working with Harris & Co. You can see all details of our agreement with them on that link too. So we've got full transparency, so you can see how we work together on there as well. And we've got lots of lovely comments coming through, lots of thanks. Thank you, this was so helpful. Thank you. So brilliant, amazing. Thank you so much, Nicola. Thanks for your time, and thank you everyone else for being here. And let's see how we can be accountable and take some action off the back of this as well. So well done, everyone. Take care.
Thank you, Katie. Good night.
Thank you, everybody. Stop our recording.